never seen myself as just one thing, and I made sure no one else could either. By staying true to myself, making my own path, rising above expectations, and opening the door for others to be their true selves. The first spirit, made with VSOP Cognac, finished in bourbon casks, Martell Blue Swift, soar beyond the expected.
Good afternoon, good evening, and good night. This is the Crypto and Cognac podcast show, and I am 𝐂𝐎𝐍𝐕𝐄𝐑𝐒𝐓𝐈𝐎𝐍. Guys, thank you so much for being with me. As always, I'm here with my Martell VSOP Cognac. Tonight, I'm having some Blue Swift. And we are talking crypto, we are talking banking, but as always, nothing that I share here this evening should be misconstrued as financial advice, guys. As always, you know how we drink our cognac, always on the rocks. So always the ice rule. It's all about information, conversation, and some education sharing. Make sure and do your own research. This is not financial advice, because today we are going to be talking about an area that I am absolutely not an expert on. I've done some research. I've been paying a lot of attention to everything that has been happening in the space, not just the crypto space, but the financial sector over the last couple of weeks. I mean, over the last few years, as a matter of fact, but particularly over the last couple of weeks with what has been happening in the banking industry. And we have so much to talk about. I'm sure by now, I mean, every other couple months, we get a new set of letters that we have to familiarize ourselves with. Right now, we're talking about SVB, Silicon Valley Bank. Everybody by now has heard the name. If you haven't heard the name, do a quick Google search. We're going to give you a little clarity here. But overall, you should really dig into that. Silicon Valley Bank is the 16th largest bank in the US, or was the 16th largest bank in the US up to last week, Thursday. They are, as of today, no longer in existence because they basically went under. They were taken over by the FDIC, the Federal Deposit Insurance Commission of the United States of America, because they couldn't meet their obligations to their depositors. So a lot of what we're going to talk about today is centered around everything that happened with the implosion of that bank. We're going to do a little comparison between that and what happened with the FTX situation, because the failures kind of both were triggered by what we call a bank run, a run on the bank. Which we're going to clarify a little bit more. Lots to talk about. We're going to talk a little bit about inflation, which is, a back end side note to everything that we see happening. We're going to talk about fractional reserve banking, which we've touched on in previous videos. We're going to talk about reserve requirements for banks. We're going to talk about deposit insurance. We're going to talk about bank runs. We're going to talk a little bit about bailouts. And we're going to talk a bit about counterparty risk, which is, I think, one of the most important elements that kind of brings everything that we're going to talk about today into some context. And basically what counterparty risk is that when it basically refers to the possibility in a financial transaction that one party may default on their obligations, leaving the other party exposed, right? And in this particular instance, the party that could not meet their obligation was the bank not being able to meet its obligations to depositors, leaving the depositors financially exposed. The government of the US in turn had to step in to kind of assure that the deposits of those depositors will be secure and safe. And that has some expected fallout to come around it. But yeah, like I said, I feel like I've been talking a lot, but yeah, it's a lot to ingest today, a lot to talk about. Let me check the chat quick. Steven, what's up, buddy? As always, representing. Yeah, we're gonna talk a little bit about SVB versus FTX versus BTC, because what people don't understand, you know what, because we get so caught up in the price action, the price volatility of Bitcoin and cryptocurrency, I think we lose track of the real value proposition, and one of which for Bitcoin has always been the removal of that counterparty risk. The removal, because in the traditional banking system, we use banks as an intermediary between ourselves and third parties to carry out transactions, right? And that by default creates an obligation between us and the bank and our third party, the third party and the bank and us. And you know what they say, too many chefs to spoil the pot. I feel like it's a bit about that. So in contrast, Bitcoin transactions are conducted directly between the two parties, which removes the need for intermediaries, which reduces the counterparty risk. Another way that Bitcoin kind of removes the counterparty risk is that you can always check whether or not the person actually has those funds in their account before you carry out the transaction. Once the transaction is completed, it's irreversible, you know, a number of different things. But we're not going to focus too heavily on Bitcoin today. We're gonna more talk about the banks. I think I want to kind of focus on the average person's expectations around the banking system and what the reality of that actually is, right? So starting with fractional reserve banking. So what is fractional reserve banking? So it's basically a system which allows banks to hold only a fraction of their depositors' funds in reserves, and they are able to lend out the rest of the money or invest it in other instruments to generate income for the bank, right? Now, this system puts something in place that the central bank of the associated territory would decide what those reserve requirements of the banks are, right? So reserve banking, basically in simple terms, let's say for every $10 or for every dollar that is deposited into a bank account, the bank is required to hold a percentage. So let's say, for example, the reserve requirement is 10%. For every dollar that is deposited, the bank has to hold 10 cents on their books, right? They could lend out the difference, the next 90 cents. Now, you could see how immediately that could create a challenge, because let's say you deposit that money today. Next week, Monday, the government decides, okay, based on their reserve requirements, not the government, the bank decides that based on their reserve requirements of 10%, they're gonna lend Stephen 90 cents out of my dollar, right? So they loan Stephen the 90 cents. Stephen go on, he buy some power mints, and that happened Tuesday. Thursday next week, before I come on the podcast, you know what I say? I ain't trust this bank thing, you know? I want back my dollar. But the bank doesn't actually have the dollar because they've loaned out 90 cents of it. So you see how immediately that could create an issue. So let's keep moving, right? I think when most people think about banks and they think about their money in the banks, especially when they put their money in a regular savings account, I think everybody's expectation about that money is that money is held in the bank 100%, right? That's why we say the money safe in the bank. But just for some context, right? Now, I just use the example of 10%, but the fact of the matter, that is not the case. So I'm going to give you all some information about reserve requirements for different territories across the world. I was looking for the information, I found most of the information as at September 2021. So if stuff has changed since then, don't hold me to it. Like I said, this is up to 2021 information. So as at 2021, the reserve requirements for most banks in the US, guess what it is? I'm going to give you all a chance to guess. You think 50%? Because it's first world, right? 40%? 30%? Stephen, you have a guess? Right? Let me tell you what the reserve requirement is. The reserve requirement in the US as of 2021 is 0%. Yeah, 0%. The banks in the United States of America have the ability to loan out 100% of the deposits of their customers. You all hearing what I'm telling you? Now, this is not just the US doing madness, you know, right? Because across the Eurozone, right, the same thing holds. Again, 0% is the reserve requirement for most banks. The UK, which is a European country but outside the Eurozone since Brexit, they are a little better, right? So not 0%. The reserve requirements for banks in the UK, 0.2%. They can loan out or invest 99.8% of all customer deposits. Yeah. Let's come closer home, right? Here in the Caribbean, in the ECCU, right, the Eastern Caribbean community, the reserve requirement is 2.5% of your local currency and 7% of foreign currency. That's what banks have to hold. In Trinidad and Tobago, which is managed by the Central Bank of Trinidad and Tobago, which based on my research so far, might be one of the most responsible central banks in the world, because they have made a stipulation that commercial banks in Trinidad and Tobago must maintain a reserve ratio of 14% of domestic deposit liabilities, so domestic accounts, TTD accounts, and 14% of foreign currency deposit liability, so 14% of foreign currency accounts, so whether that be US accounts, whether that be GBP or any other foreign currency deposits, 14%. And that's actually the highest I've seen so far. And well, also they also have reserve requirements for non-financial entities as well in Trinidad and Tobago. I didn't do the research on those for the other territories, but in Trinidad and Tobago, the reserve requirement is 7% for local and 7% for foreign, right? So that's your I guess your unit trust might be considered a non-banking financial institution. Credit unions definitely fall into that categorization as well. So we already start to see a challenge forming, right? Because if banks are allowed to loan out majority, in some cases all, the deposits associated with their depositors, how do they manage liquidity to ensure that when customers come a calling, they have access to those funds? Right? So that's one part of the equation. Now, comparatively, crypto exchanges like FTX were required to hold 100% of customer deposits, regular crypto deposits, one-to-one, not the dollar amount, but the value in crypto. So if you deposit 5 Ethereum, they're supposed to hold 5 Ethereum. If you deposit 5 BTC, they're supposed to hold 5 BTC. Right? Now, the fact of the matter is that FTX wasn't doing this. And that is what led to their downfall ultimately. But when you look at the traditional banking system and even the crypto exchange market, you will see that although people are critical of crypto in terms of it being risky, in terms of it being unregulated, the processes that are put in place to protect depositors are even more stringent. Even though they are self-enforced, they are even more stringent and significantly so than the traditional banking system. So it's 0% for US banks. Crypto exchanges is not 10%, not 15, not 20, not 50%, not 75%. 100% of crypto funds are supposed to be, depositors' funds are supposed to be held. Now that's different from your margin accounts and all these kind of things. We're talking about your spot deposit accounts, your spot crypto accounts. So when people start talking about banks being safer than crypto, yes, the currency itself may not fluctuate as much. Like, crypto prices fluctuate. But if you have one Bitcoin, that exchange supposed to have your one Bitcoin waiting on you whenever you do decide to withdraw it. Now, a lot of people then say, okay, I get it. There is reserve banking requirements. The banks lend out some of my money. That's cool. But the reason why I trust banks is because if the bank fails, I have deposit insurance coverage, right? Which banks pay for. And while deposit insurance does cover and take care of majority of the lower income people and do protect the masses, it does not cover you 100%, right? And we're gonna talk a little bit about, I'm gonna do some comparisons of what that looks like across the world. Now, in the US, deposit insurance covers 250,000 US. I think that's per depositor per institution, right? So not per account, per depositor per institution, $250,000. But anything above that, you're on your own, or you're supposed to be on your own, right? In Trinidad and Tobago, and again, guys, this is as of 2021. So if it has changed, do not kill me, right? Just type it in the comments. In Trinidad and Tobago, deposit insurance covers 125,000 TT dollars, or about 18,000 per depositor per institution. So know that if you have more than $125,000 in any bank, if that bank, God forbid, was to go under tomorrow, all you are required to get back from the Depositors Insurance Commission is $125,000. So this might be why so many people have accounts in every single bank in the country, because they had to spread it out. They had to put 125 here, 125 there. I'm not calling no bank name, but maybe that's why it's like that. Now in Jamaica, its deposit insurance covers 600,000 Jamaican dollars, right? Which is just over $4,000 US. So anything above that, you're in the win. In the ECCU, it's 20,000 EC dollars. Again, just about $7,000 US. And in Barbados, it's 25,000 Bajan dollars or 12,500 US. And again, that is per depositor, per institution. So again, if you have more than $12,500 US in a Barbadian, in a Bajan bank account, you have more than 7,400 in an EC bank account, you have more than 4,000 in a Jamaican bank account, or you have more than 18,000 US in a TT bank account, you are exposed to the potential counterparty risk associated with the reserve banking, the fractional reserve banking system in your country. Because the fact of the matter is that at any point in time, should a bank go under, that is all you will be covered for, right? Now, why is this even something you should be worried about? We're talking about bank runs, right? Because ultimately what led to FTX being, I wouldn't say going under, because they would, I think long term, on a longer time frame, they would have gone under anyway. But what caused them to go under on that particular incident was the fact that some news came out about their financial setup, them being somewhat exposed. People started to get afraid. People started withdrawing their money, right? And as more and more panic set in and more people started to withdraw their money, they started experiencing something called a bank run, right? And this is basically when a lot of customers start looking to get back their money, starting to withdraw their money. And within a couple of days, billions of dollars were withdrawn, and they couldn't meet the request by their depositors, and they had to pause withdrawals on the platform. Fast forward a few months later, same thing happens to Silicon Valley Bank, right? Some news comes out that they are not in the best financial position because of some challenges around the bond market, and customers start withdrawing their money because they want to protect themselves as quick as possible, right? And as customers start withdrawing their money and really causing a run on the bank, more and more people panic, more and more speculation about the bank not being able to meet its commitment. The bank share price starts to dive like crazy, similar to what happened with FTX, and their FTT token started to dive. Yes, Stephen, all this because of the bond market and rate hikes. So basically what happened is that so bonds are a significant part of the investment portfolio of banks, right? Banks purchase bonds as a way of investing their excess funds, your funds, and a way of generating additional income. Now, when interest rates in bonds increase, the value of bonds that you would have already purchased, bonds that you would have already been holding, tends to decrease, because now people looking to buy the new bonds, right? So your ability to sell back the bonds that you already own is decreased. So the value of those bonds go down. So that obviously negatively will negatively impact the value of a bank's portfolio, because the portfolio is assessed based on the value of all those assets which bonds are a part of, right? So let's say you have $100 million in bonds. As bond rates increase, and that is what was happening with the because of monetary policy by the Federal Reserve Bank. As bond prices increase, they found it hard, more and more difficult to sell the existing bonds that they had when they needed to redeem it to be able to pay people the money that they were trying to withdraw, right? So now instead of having $100 million worth of bonds, you might have $95 million worth of bonds, which is a $5 million loss, right? So how do you bridge that gap? And as those things show up on your books, it's all about confidence. This whole financial system is built on us trusting each other and trusting each other's ability, like I said, to deliver on our obligations to each other. So from the time one person seems like they're not able, or one entity seems like they're not able to deliver on their obligations, everybody start panicking. And then the house of cards come down. So bond rates started going up, devalued the existing bonds on the books of this bank. They started looking bad. People started withdrawing their money. They couldn't meet the obligations. Stock price started to fall. They end up pausing the trade of their stock, I guess, to prevent it from going to zero, because everybody looking to bail. This ship is going down. Nobody trying to go down with the ship. And interestingly enough, as I say, nobody trying to go down with the ship. It was interesting that while all this was happening, some of the key executives of this particular bank were selling off their shares days before the news came out, right? So the CEO, I think he sold something like $3.6 million worth of shares. The CFO was selling shares. The CMO was selling shares. All the C's and the O's was trying to get out of there. None of the captains was trying to go down with the ship, which further created fear. Anyway, ultimately, the FDIC stepped in and decided that they were going to take over operations of the bank. Initially, fears set in that a lot of customers would not be able to be made whole. A lot of depositors would not be made whole. We started to see that because Silicon Valley Bank was a major banker for startup and venture capitalists. The whole tech market was very, very shaky. Companies like Roblox would have identified their exposure. Companies like Circle, who are the issuers of USDC stablecoin, identified that they themselves had some exposure to the bank, totaling $3.3 billion. That caused there to be fears around them not being able to meet their obligations. That caused that particular token to depeg its one-to-one peg with the US dollar, dropping as low as 80-something cents on the dollar. So everybody was feeling the burn. I'm sure a lot of politicians were having their phones blown up as people, started trying to get the government of the United States to step in and do something. Ultimately, they did. They decided to a bailout that would basically guarantee all the deposits at the bank using the funds from the FDIC. They claimed that no taxpayer money would be used. But the fact of the matter is that the FDIC doesn't have enough money to cover that. So the money has to come from somewhere. And then we started seeing, a lot more information coming out about it. Different countries were being impacted. United Kingdom had to step in. They got HSBC Bank to buy the US subsidiary of SVB to prevent further contagion affecting the UK market. We are still seeing fallout with other banks now in a similar situation, again from the same bond crisis. First, what's the other bank, Stephen? Besides Credit Suisse, yeah. So we're seeing Credit Suisse, or however you pronounce it, the Swiss bank, Credit Suisse. They are being affected by a similar bank run and sell off of their stocks. It is basically a whole shit show, right? So the government has stepped in to bail out yet another one of these banks. Let me see if I can find it. I'm having a real brain fart right now. Sorry, guys. First Republic, thanks, Stephen. You see, this is why Stephen here, right? First Republic. I know it was something like one or two of our banks here in Trinidad merge now. First, but I kept thinking First Citizens. I was like, no, it's not First Citizens, it's not First Caribbean, something else. Yes, First Republic. Big up to Stephen always holding me down, having me back. Yeah, so they announced a bailout of First Republic as well. But ultimately, all this bailout money is coming from somewhere, right? And the government has stepped in to create a credit facility for these banks to allow them to be able to cover the expense of all these withdrawals that are happening, right? So these banks can borrow up to a particular amount from the government to be able to cover deposits as there continues to be a bank run on the system. And the scary thing is that the limit for that loan facility is $300 billion, right? Now, where did that $300 billion come from? Nowhere, right? That money was printed basically out of thin air. And what does that basically do? So somebody posted on Twitter that the 297 billion expansion of the federal balance sheet since last Friday has effectively erased 54% of the 545 billion of quantitative tightening enacted since June 2022. Months of progress reversed in days. So the Fed was trying to manage inflation based on everything that was happening by quantitative tightening, raising the rates. That raising of the rates led to bond rates going up, which led to existing bonds being devalued, which led to banks being exposed, which led to loss of confidence in the banks, which led to a bank run, which led to the government having to step in to protect depositors, which led to them having to print money out of thin air and undo everything they did with the quantitative tightening. So I don't know what the fuck we're doing. Right? It seems like we're going in circles, right? Guys, and when I tell you all, I am scared. And when I tell you all, this is why I am so adamant that adoption is inevitable. because every time the government prints money out of thin air, what it does is devalue the money in the current system. And that devaluation of the money in the current system is what is represented as inflation, because there is more money in the economy to pay for the same level of goods and services. So obviously, the price of those goods and services are going to go up. So what happens to the man, the average man who is plugging away, saving his money diligently, working hard, paying his taxes, making sacrifices, putting his money away in the bank for safekeeping? One, his money isn't safe because banks could go under. Two, even if the bank don't go under, his money is being eroded by inflation. Now, there are other financial assets that people could invest in that might be able to keep pace with inflation, like real estate. But how many average people can afford to buy properties, get started in real estate, get started in gold, or buy gold? And even if you buy gold, are you buying gold or are you buying the digits on a screen? Can you custody that gold? Even if you custody that gold, what are you going to do? Walk around with a bar of gold in your pocket? You're going to store it at your house? If you need to leave your country, how are you getting out of the country with it? And this is why I believe Bitcoin is here to save us all. And what we are seeing now happening in the West is something that we've seen happen before in Lebanon, in Nigeria, in Argentina previously, and now it is in our backyard, where we are seeing Western banks, top banks. The US has over 4,200 banks, and one of the top 20 banks is no more, went under last week. Guys, I don't know what to say again. Bitcoin fixes this. Yeah. Not financial advice, but Bitcoin allows you to self-custody an asset that is portable, that is digital, that you can access from anywhere in the world, that you could send anywhere in the world without an intermediary, that reduces the risk of counterparty failures. It's not just about if it's 26,000 today and 50,000 tomorrow and 100,000 next week. It is a scarce deflationary asset. There will only ever and always be 21 million Bitcoins, which means it's a hedge against inflation. My greatest regret is that I don't have enough money to buy all the Bitcoin that I want. Do your own research, guys. I mean, yeah, cool wallets are your friends. Learn about it. Learn about how to custody your own funds, because even exchanges going under. Yes, it's the easier way to do it when you're getting started, but make sure and get the information, learn about it, learn how to self-custody your funds. You don't need a hard wallet in the initial stages. If you only have $100 worth of Bitcoin, you may not need a hard wallet, but there are free apps out there that give you access to wallets, whether it's the Bitcoin.com wallet, whether it's Exodus wallet. If you're custodying other cryptocurrencies, there's MetaMask, there's all kind of different wallets. There's so many wallets out there that allow you to custody your own funds. But I would say that seeing another potential global financial crisis in less than 15 years from 2008, when Bitcoin was originally thought up and then eventually invented. And it's scary, but this is exactly what Bitcoin was created for. And that is why I think we are seeing, while all the other markets are going down, while bank stock prices are crashing into the ground, Bitcoin has been pumping like never before over the last week, up 24% in a matter of days. Is because people are realizing that, I need to find a way to custody my own funds. So guys, go seek the information, do your research, and make it happen. I hope I was able to create some questions in your mind that you could go and do some more research on. I hope I was able to answer a few basic questions to get the train moving in your mind. I will see you guys again next week, Thursday. Same bad time, same bad channel. Steve-O, where said it? BTC pumped 60% this year alone? Well, who do hear this feel? My grandfather used to say that. Who do hear this feel? Guys, I hope I am doing my part, giving you guys some exposure to this thing that could, potentially save our lives. It might be slow, but I truly believe that adoption is inevitable. As always, guys, thank you for being with me. Illuminati, OUT, be blessed. See you guys next Tuesday, 7 p.m. sharp. Bring a friend, bring a drink. Let's have a good time. Cheers.